So welcome, everyone. So I'm very happy to start this second day of the second meeting of our spring talks. Um, Last week was a very nice day, was a success. Today will be again. Once again, we are here all together with colleagues and even more with friends, which I would like to thanks to be here with us today. And I wish to thanks Professor Annunziata, firstly, because at the end of the day, if spring talks, are true, are real, I would say, thanks to him. So thank you very much, Professor. And today you will have the lead of this meeting. As we know, we have very nice and interesting paper to discuss about. So if you agree, we could, I would say, let the author to talk about their research. But firstly, we would be very happy if you could give us like a few words concerning this second day. Thank you.
Thank you, Federico, and thank you to all the attendees, and especially to the four researchers who will present their papers today. And we have actually four topics. The first is SPACs, which is one of the main areas of interest of Maria Lucia Passador. She's been studying this topic extensively and publishing quite a number of outstanding papers. So we are very curious to hear her presentation. And then we have Matteo Gargantini, who actually just published a few months ago an outstanding monograph on regulated markets, which at last now deserves the attention that it actually deserves by legal scholars as well. And he'll be presenting a paper on the European regulation of securities exchanges. And then we'll have Andrea Minto from the University of Venice, who is tackling the topic of AML and financial innovation. And last but not least, Federico Urbani, whom I know very well, who is presenting a paper on the DORA proposed regulation on the digital operational resilience, which is part of the Commission's digital finance package. Now, at least three out of these four papers, but also the one by Maria Lucia, but the one by Matteo, Andrea, and Federico have clearly this sort of technological flow or flavor rather, because they touch upon fundamental topics of financial regulation, but with a particular eye to new technologies and broadly speaking, fintech. We know how much technology is fundamental for the functioning of trading venues. This is a very traditional topic, or rather phenomenon, because technology has completely overturned and changed the face of trading venues and regulated markets first, and then MTFs, OTFs since the 1980s. And today, technology is really at the core of the functioning of trading venues, with particular peaks of interest, such as algo trading and high frequency trading, where technology is in itself a topic for the regulation. It's not just part of the regulation, but it is the topic that regulation needs to deal with. And then also Andrea Minto is going to look at how technology may support AML regulation and supervision. And there's a lot here that needs to be said, including naturally the ever-present algorithms that are fundamental for the purpose of anti-money laundering, KYC, detection of suspicious transactions, and reporting of suspicious transactions. Now, we are in a moment, as most of you are aware, of deep transformation of the European institutional setup and supervision on anti-money laundering. We are moving towards the creation of a European agency for the area of money laundering that would stand along the other three already existing European agencies. Naturally, I'm talking about the EBA, ESMA, and the EIOPA. So the the paper by Andrea is particularly important because it also looks at what is going on in the context of re-regulating anti-money laundering, which is not a new topic at all. It's the fifth anti-money laundering directive that we now have enforced, but his paper will provide new interesting insights on technology and the evolution of money laundering regulation and supervision. And then Federico Urbani is really fully submerged or immersed in technology, because his paper revolves around the third regulation of the proposed, as I said before, EU digital finance package. And I must say that I'm very interested in what Federico will tell us, because this regulation is at the moment probably the one that has received the least attention. Maybe because it's so technical, a little bit sort of difficult to understand, or doesn't really seem to tackle exciting topics as the ones that we are constantly discussing every day, such as artificial intelligence, ESG, but it is really a fundamental part of the EU digital finance strategy, because the two other regulations that everybody's talking about, especially MiCAR, the king of all EU digital finance regulations. Everybody's very excited and everybody talks about MiCAR. But the MiCAR in itself would make little sense if it weren't backed up by the DORA regulation, because MiCAR is based on technology. It's about regulating a technological phenomenon, crypto assets and whatever. And if technology fails, if technology is not resilient or robust enough, then it is very difficult that MiCAR might achieve any of the intended objectives, including that of creating a pan-European market for crypto assets. So I must say that we are all grateful to Federico for his courage in taking up such a difficult and a little bit daunting topic like DORA, and discussing it in the context of this seminar. And then also the presentation I left her at the end, because apparently from the title, the presentation of Maria Lucia doesn't have this strong fintech or technological flavor, but actually, the whole market of SPACs and the new techniques that are being employed in the context of SPACs, whether they are used in the US markets or in the European markets, has a lot to do with technology as well. Also because some of these SPACs are targeting fintech companies or companies that have a high technological flavor, and it is not by chance that the phenomenon of SPACs was also sort of developed on the market alongside with fintech, with the development of the fintech industry. Now, naturally, SPACs have a wider scope of action. They most of the times have little to do with technology, but they are part of the new topics that we are discussing, including fintech, and they sometimes have a strong connection with the fintech phenomenon. So I would say that I left Maria Lucia at the end of my presentation, but now I would give her the lead and ask her to present first her paper on SPACs, and then we can move along with the other three presentations of today. Maria Lucia, you have roughly 20 minutes for your presentation, and then we can have a few minutes for Q&As or discussion at the end of your presentation.
Professor, I just want to say one thing, sorry, just for the attendees, and in order to just give an idea about the spring talks before the end of the seminar of today. Just remember that we're going to have then other spring talks at the beginning of May. that will be interesting for everyone. Will be with the more about sustainability. It will be with the EUSFiL. So with Professor Siri, that is the other, I would say, key man that helped us a lot in organizing all these events. So today will be very interesting, but also don't miss the other meetings we're going to have in 2 weeks from today. So thank you once again, Professor, and Maria Lucia, thank you very much for being here, and I can give you the floor.
Thank you very much, both to Professor Annunziata and Federico, and thanks everybody for attending the seminar and to the European Banking Institute for having us. So today we're talking about an acronym, a four-letter word that actually made up the whole IPO world, especially in 2020 and 2021, that are SPACs. And short form, special purpose acquisition companies. SPACs are purpose-built vehicles established with the aim of collecting financial resources for an IPO on the stock market to identify first and then to incorporate through the so-called business combination an unlisted operating company and lead it to listing. Indeed, it is a borderline product between the capital market and the classical private equity, since although the fact that it retains the characteristics of an open-ended capital company from the outset, that is reflected in the marketability of shares, it also carries some typical features of the closed-end private fund manager's investor contract. Today's agenda starts from an historical overview and a brief comparison with classical tools, leading to examine the recipe for SPAC success and SPAC structure in the pre-COVID scenario, especially in the United States of America, focusing on the length of the investment horizons and on institutional investors' behavior. Moreover, thanks to some data that have been provided also by leading institutions, we will describe the 2020 scenario, focusing on litigation costs, D&O insurance, and rural pipes. Lastly, we will tell about the pre- and the post-COVID comparison, and I performed an analysis in order to check the evolution of the most severely affected sectors, as well as the financial advisors market in terms of market shares and player concentration. So, to make the long story short, in 1993-1994, in the United States, an investment banker launched 13 blank check companies, which from now on we are going to call SPACs only. But even earlier, we can say that there is scattered evidence that at the beginning, the blank check companies appeared in England when there was sort of blind pools as a way to actually address them with regard to the South Sea bubble in the form of investment trusts. However, if we investigate them thoroughly, we find that after 1955, we had similarly structured operations set up by truck business, McLean Industries, and to avoid regulation that required approval for the merger of a business truck and shipping, Malcolm McLean founded an ad hoc publicly traded company named McLean Trucking Company, with two siblings. We might call it a vehicle right now, and he put control of the truck company in a trust to their benefit and allowed trustee to sell all stock except the $5 million held by the family. He stepped out from all the roles he had in the truck company and starting them on in a new co. Right now, in 2003, thanks to an investment bank, Early Bird Capital, we have a very first structure of SPAC that was admitted to be listed on the OTC, giving rise to a steadily growing trend, with the sole exception of the decline in two periods, that of the boom of high-tech IPOs and, of course, that of the financial crisis. It is conceivable that given the common purpose of all SPACs, SPAC's life cycle is actually a circle, so it's highly standardized, and it is so standardized that also this leads to a graph that is divided into multiple phases, but can be even more simplified, dividing it into three main phases: the listing, the identification of a target company, and the acquisition or liquidation of a very same company. The money earned from the SPAC's IPO and the profits that derive from the initial and the additional investments of the founders are then segregated by the means of different kinds of accounts. And it is very effective as an illustration, because basically it offers a step of each phase. Once the board of directors of the SPACs identify a potential target company to be acquired. Then it reaches an agreement with its shareholders, and the general shareholder meeting is called to resolve about this deal. And it also enjoys a significant right of vote with respect to this decision. In the case of US market, at least 80% of the segregated funds must be used in order to conclude this acquisition. And generally, this conversion threshold is also a proxy of the risk of appetite and confidence of managers in the successful outcome of the transaction. So generally speaking, the fact that the shareholders decide to proceed or to reject the proposal about the potential acquisition leads to basically two different alternatives. So the fact that the target can be found, and so the merged company commences trading, or that if no target is found and the proposal is actually rejected, then we just go back to the very initial phase. Notably, and that's very relevant, the advance of European SPACs first occurred in 2017, but it did not actually regard the London Stock Exchange as perhaps everybody back in 2017 would have expected. But it actually was related to the Amsterdam market. And the following years, the turn down also involved other markets, and the Italian one was also pretty relevant in this case. After the Brexit occurred, we had a couple of alternatives, and also the recent reform of the UK regulation led to a completely different attitude of the UK that right now are trying to regain attraction in the face of the general SPACs market. And I should also add that the study of SPACs shows that most of them do not have a Europe-wide focus, either in terms of investors or in the choice of target companies. And those are very heterogeneous, especially in the selection of the target. Generally speaking, we should also add that very briefly, this is not only a US or EU phenomenon, but it also interests New Zealand, Mexico, and generally speaking, it's something that can be affected by the general local market. We can say this because basically also in Italy, it is something that normally tries to overcome the undercapitalization and the systemic reliance on the bank credit in our country. So this resulted in the increasing use of private equity and IPOs in our market, while at the same time finding an appealing substitute for SPACs, thanks to the US experience. Generally speaking, so we should say that the rationale for a comparative analysis is also pretty strong in this regard. So this, the 2020 figures actually that we will analyze later on can't actually be studied without having regard to what happened in the pre-COVID area. So the first research question is, which is the recipe for success for SPACs? And we can generally say that looking at the overall income volume of IPOs and the number of US listed companies that actually started to really be involved into this phenomenon, well, we can see that after the slowdown due to the financial crisis right now, so we can even look at 2017, total volume of transactions substantially increased. And this is also a sign of the fact that besides the doubling number of the deals, there has been a general increase and also involving different kind of markets. Overall, this is the sign and the evident a reflection of the positive and smooth structure from the standpoint of companies, of the investors and sponsors that are actually involved in this, because you can see that there are significant numbers of wound-up companies, which means that sometimes they do even just try to be involved in a SPAC, but they don't end up being completed. But also at the very same time, we can say that some attempts in the period considered actually kind of failed nonetheless, because the companies did not find a proper target. We can also say that the timing needed to actually conclude the transaction is on average a little bit longer if actually the SPACs turns out to be a successful transaction, because if they complete the business combination. Because generally speaking, this is related in this graph to the fact that sometimes they really can decide to proceed and ask for a 6-month additional period in order to really complete the transaction, or in some other cases they decide not to complete the transaction, and so to reject the proposal made with respect to the target. What is the rationale behind this data? So behind the fact that maybe a little bit more time enhances the chances of the SPAC to be successful? Well, probably this means that we should need a little bit more time in order to really understand the transaction, or perhaps that the experience of managers has an impact in that. And also that in some other cases, founders may be considered as having opportunistic behaviors if they don't present worthy deals to shareholders. So there are various reasons, but that's something pretty relevant in this period. We can also say that in this period, so without being affected by the COVID uncertainties, there were some cases in which SPACs were liquidated. And we can also understand that the reasons are multiple from the analysis of the documents, but most cases because the target-related problems were detected afterwards, or because of the fact that no target was found. But generally speaking, in some cases when the General Shareholders Meeting did not approve the specific transaction, there were quantitative uncertainties that actually led to this ultimate reflection. Then we can say that from a merely quantitative point of view, we do have a problem because it's really difficult to actually get a standard measure of SPACs to evaluate their performance over time. The fourth example of a benchmark index for SPACs is Morgan Joseph Acquisition Company Index that was actually used by the US Merchant Bank. And there is a market capitalization value which is weighted. And the weights are the market capitalizations of the company that are balanced upon the exclusion or introduction of a new SPAC. Also, we have to say that it is relevant, but it dates back in time, and its latest update dates back to March 2014. Other indices have been built, but none of them has a really satisfactory outcome. So we must say that this should be improved as well. In Italy, I just briefly mentioned the Italian case, saying that the economic background is pretty relevant. But Italian SPACs, which are mainly listed on the AIM market, are normally like smaller than US ones, because generally in 29 cases, 29 listed SPACs or collected ones were actually relevant in the period between 2011 and 2019. As opposed to what happens in the US, most of the SPACs in Italy are generalists, so they don't actually aim to find a target to be acquired within a specific sector, but normally they just try to look at something more general. Although there are some events where a negative value actually was recorded, and so in these fields they normally don't actually operate. The target normally in the Italian market is configured as a medium-large enterprise that is sound and healthy. And this is particularly relevant, and I wanted to underline this, not only because we do have an Italian panel today here at the European Banking Institute, but especially because in the United States, it was completely different, because there was no full growth model of the SPACs, and SPACs are not normally as healthy as the other companies that normally we met in the US scenario. So in Italy, no investments are made in companies undergoing restructuring, or business combinations normally are not actually used for the purchase of business units or assets. As a preliminary comparison between the two contexts, we can say that the time frame right now is much more flexible in both countries, and especially we can also reveal that generally there was an extensive 6-month period that actually was available for US companies, and that's what I mentioned beforehand when I said, okay, in the given period some SPACs transactions were not completed, but actually they required an additional time. And actually this happens also in Italy after that time span, and this is something that actually gives the possibility to lead to a smoother transaction over once actually a letter of intent with a chosen target group is signed. The difference in terms of remuneration of promoters is actually significant in both areas. And in both countries, also the number of warrants assigned to investors at the time of listing decreased, and the number of warrants allocated after the business combination to those who decided not to exit is proportionally increased as a bonus. The US example and landscape is characterized by a remarkable internationalization, and the Italian example of a benchmark index, as we said, is pretty limited and is not as complicated as the ones that we actually just saw in the previous slide in the US market. It seems appropriate to actually proceed understanding the recipe for success of SPACs, because although they don't really represent a traditional type of listing on the market, it is nevertheless extremely valuable to really understand that they are an extra tool that is given to the market, and it is like my very final opinion on them. So they really are a tool that is given to companies in order to really straightforward obtain the very same aim of the IPOs, although with significant regulatory differences that are also right now tackled by a recent proposal dated March 30, 2022 by the US SEC. Active investors, in fact, generally were related to this kind of transaction in order to generally let founding members have a predominant role, and they normally were the ones intervening directly to grant the success of operation. And this is perhaps like the very recipe for success. Also, the system is not immune to limit some problems, because the conflict of interest indeed is the main one. From a quantitative point of view, the importance of actually setting a benchmark index has to be stressed. And the sample examined allows us to pinpoint the salient trends and to draw up the identikit of the perfect SPAC containing those ingredients that prove to be actually effective in that scenario. It doesn't show a possible correlation between the previous and the following phase with respect to the business combination, nor between the size of the listing and the acquisition operations and the process of identifying and purchasing the target, with the exception of the overall SPAC's lifetime. We need to be flexible in assessing their effectiveness, because the investment of the founders following the listing and the percentage held at the voting time were not normally significant with respect to the economic performance of the target. And at the very same time, the executive role maintained in the company by the SPAC's managers after the acquisition seems to be positively correlated to the results of the company. The skills and experience are the key to achieve the best performance in the medium term. And so we can say that the real determinant of the successfulness of SPACs are the variables implemented in the listing process, or anyways, the ones that actually were used before the business combination is adopted. We really understood this after the analysis of these transactions that occurred from 2003 to 2018. And as I highlighted in this slide that we previously saw beforehand, no COVID and no overlappings with other studies of the topic actually affected this kind of scenario. But the second actually research question that right now can actually be raised is, are SPACs investment long or short-term ones, and are shares sold when profitable or not? And the question in this case is the fact that it's really important to understand whether after the business combination such investments have short or a long-term perspective, and whether shares were profitable at that time in which they were sold. And to capture this phenomenon, the analysis of price fluctuation and the number of available shares has been used as a proxy, because once I calculated the ratios for all the available SPACs observations in order to understand if there has been dilution or a concentration, I analyzed the year N to the year N-1 ratio delta. And basically, there are three possible scenarios. So if it's above zero, there has been a dilution in terms of shares or a lower value in terms of price. If it's below zero, there has been either a concentration in terms of shares or a high value in terms of price. If it's zero, then there is no variation as happened in the most, let's say, in the most relevant number of cases. As far as SPACs are concerned, we can say that both in absolute and relative terms, the change and volatility of the market led to meaningful changes, and also it increased a lot. There was, whereas a dilution, I'd say, was characterizing the years between 2012 and 2019, then there is a concentration driven by the massive use of the SPACs tool in 2020, thus making it possible to register a general increase of prices and a reduction in the availability of the shares associated with the analysis of the transaction. Overall, the general market variations over the last 10 years show a general dilution trend with the presence of short-term investments. And this trend is even stronger to reverse the opposite effects of the years 2011 and 2020. As far as IPO, this trend declined substantially, and also due to the increase of the upstay of SPACs, IPOs experienced a sharp reduction in the growth in the following years. Generally, the average variation of the market over the past 10 years shows a dilution that demonstrates the presence of short-term positions that normally is less prevalent than in the case of SPACs, reinforcing the idea that while the phenomenon of short-term investment may be similar with respect to both instruments, then it is slightly less evident in traditional IPOs. We can determine also how many institutional versus retail investors were involved and try to assess how long they are engaged in the projects. I sampled 216 companies undertaking a merger from 2010 to 2019, and we have an average of 18 to 19 investors. In this time frame, there are 16 types of investors, but mainly financial companies, corporations, pension and mutual funds, banks, individuals, families account for more than 10% of them. What is more important is that generally institutional funds as a whole, like financial companies, mutual and pension funds, nominees, trusts, whatever else, accounts for 60% of total shareholders, and that's pretty relevant. And as to the change in their investment strategy, comparing absolute to relative numbers, on average, it seems like the strategy tends to be overall decreasing, but in the most recent years, a more unchanged position tend to prevail. As to the upward trend, it's noteworthy that banks have both the lowest level of unchanged and the relatively high change of increased change. That is consistent with their business model, because banks normally do have revenues generated by high-frequency transactions, mixing stock shorting and longing strategy by financial speculation in general. Whereas the unchanged strategy is favored by families and individuals that normally tend to actually use this kind of instrument for a longer time. Looking at the behavior of each category of investor, the decreasing strategy is prevailing among institutional investors that have their core business in making profits from closing deals without being directed to actually link to a specific firm. And they prefer short-term investments to employ their capital they retrieve from deal closing. Moreover, we can say that the strategy that is adopted by them works as a transfer of wealth from retail investors to them. We can also say that looking at the overall picture, the volume of IPOs and the number of US listed companies in the pandemic are related. It's also really important to strike this time frame. So in the period until December 2019, we can see that both values greatly are relevant until 2007. And after that,
yeah, I think you should reach the conclusions. Thank you.
Absolutely. And so generally, we really have this kind of scenario in order to actually lead to a wider listing in this case. Liquidation actually took a central role in that case, because liquidation led to the fact that we have a downward trend for the number of deals that don't have in SPACs, but a repayment of investment capital to shareholders. The 2020 spectacle can briefly be summarized because generally we have a really relevant upturn, and that the similarity leads to a structural incentive for private firms not only to go public, given their evaluation, but to do this specifically through the SPACs. This leads also to an increase in litigation that is particularly relevant in 2020, and an increase in D&O insurance, because while in the period between the actual selection of the target and the actual business combination, the D&O coverage is rather limited, then after the D-SPAC, its costs are particularly relevant. And in 2020, the demand has driven SPACs to have a D&O pricing up to 4 times as the previous result, because basically actually the market was so wide that it led to multiple risks that were to some extent mitigated by the private investment in public equity intervention. So the fact that some accredited institutional investors, and that's perhaps the most relevant phenomenon in 2020, intervened in order to really to conclude and arrange a private arrangement in the end of the SPAC. As a consequence, we assert that SPACs are a financial and a legal innovation tool, and they are particularly relevant in this case because they are offering something more than what before 2020 the market used to know. We can also say that with respect to the duration of investments, it's noticeable that both IPOs and SPACs tend to maintain their holdings for a short period of time, and that liquidation cases decreased over time despite the moral hazard consequences that a few liquidation cases can bring. SPACs can actually seem to be ready not only in terms of SPAC structure, but also of the ability to cover sustainability issues and also tech ones, as Professor Annunziata underlined at the very beginning, that is like the fil rouge of today's discussion. It is a long journey, but there are a lot of open questions, as actually the fact that SPACs can be of a benefit for the market, or can actually adapt to their regulation to the needs of the market, or on the other hand, if we should consider them expired once the pandemic is over, considering them as a bubble really going to burst.
Okay, thank you, Maria Lucia. There's a lot of information and elements to be developed from your paper. Federico, how do you think we should move ahead? Shall we leave?
I would say, Matteo, if you want to start. Maria Lucia, thank you so much once again. Matteo, so it's up to you. Thank you.
Thanks a lot. I would ask the organizer to activate my sharing function because it's now deactivated, so I cannot share my screen. But perhaps while that problem is fixed, just a few words. Well, first, thank you very much, Professor Annunziata, for the kind words. Okay, perfect. Now I can do that. And I am glad also to talk about a topic that I think also shows perhaps a second form of fil rouge, a second kind of fil rouge. But of course, still when it comes to technology, hopefully you should be able to see my screen soon. Actually, I always like to adopt a very broad concept of technology and of technological development. I always see that as a form of doing perhaps even old things, but in new ways, in more efficient ways. And I think this applies, of course, to the SPAC idea. So that's how to get listed in a new and more efficient way. And that's also one notion of technological development that I'm going to consider in my presentation. And next to that, I will also make reference to a narrower understanding of technological development, which is the use of artificial intelligence in the stock trading world. So, hence the topic of my presentation, which is about securities exchanges and how to cope with technological developments, but also regulatory challenges at the same time. So I will divide my presentation into 2 parts. The first one is a rather methodological one, and that's the most boring part of my lecture. I'm going to tell you. I will have an eye to see how many attendants are leaving in the meantime. But that's perhaps the most important one. I was told that in the audience today, we have a lot of PhD candidates. So I think it's also good to convey some general message on the way that I believe is the best one to approach regulatory concerns when it comes to securities exchanges. I will interchangeably use the word securities exchanges, which is more a jargon, and regulated markets, which is the legal terminology, or trading venues even more broadly. I will refer here to the platform economics, and we will try to understand a little bit what kind of messages platform economics can give us. In the second part, and then I will apply this methodology to the specific regulatory problems that are coming out of high-frequency trading, so out of the application of artificial intelligence, so from algorithmic trading, and in particular high-speed algorithmic trading. As I always happen to do, I will rather ask questions that give answers, but hopefully I will try to do that in a sort of a coherent framework. So let's start with the methodological part. Again, well, stock exchanges or regulated markets in general are platforms in an economic sense. That's far from being new, so I'm not reinventing the wheel here. But if you look at the literature on the topic, when it comes to understanding what kind of platforms regulated markets are, well, there you see really a broad array of different opinions. You have scholars telling you, well, they are one-sided markets, so basically you can identify only one user group, people that are interested in the investing or divesting, so basically in the purchase of the trading services. Some others will tell you they are essentially two-sided markets because they are connecting issuers on the one side of the platform with investors on the other side. And somebody else will say, well, they are actually multi-sided because on every part of the platform you have different users groups, so not all investors are the same. I would say that perhaps all these classifications are correct. It depends really on what you're looking at. And this is the first point of my methodology. So if you start actually on the methodology I will use today, if you look at the dynamics that develop within the regulated markets, you will see that basically you can analyze the different user groups and the different consequences that every technological and regulatory development can have on every group of user. And you can zoom in or zoom out depending on what you're looking at. So if you're looking, for instance, at the broad picture, you can say, okay, investors might be affected in a certain way, issuers might be affected into another way. But again, investors, for instance, are not equal. So large investors and small investors might have different interests, and they might be affected in a different way from the same technological development, such as artificial intelligence. But again, large investors are not all the same. Some of them rely on high-frequency trading techniques, some others do not. And even those that rely on high-frequency trading techniques are not using those technological tools in the same manner. For instance, market makers do not use them in the same way as directional traders that actually try to make money out of arbitrage, for instance. And this is the reason why I normally use with my students this image of the fractal broccoli, because that gives the idea of a fractal system, so of a self-similarity in the organization, in the economic organization of the trading industry, meaning that for every kind of analysis, you can zoom in at the deeper level, and you will see that at that level you will have a structure of your analysis that is very similar to the broader one. You're just zooming in, but you are basically still analyzing different interests that may be involved by the same dynamics. And to further complicate the picture, as we are talking about platforms that have different sides, typically, actually, every development that you can first notice on the one side of this platform will have impacts also on the other side. So for instance, if you're changing the, in our example, if you introduce the use of the artificial intelligence on the trading part, you will see that that might have an influence on the quality of the prices that the markets are producing. So you will affect the market data. Stock exchanges, as you know, are not only offering trading services, they're also selling data, in particular market prices and the order book. So that's another activity that they carry out. And the way trading is carried out has an influence on the quality and the nature of the market data, which in turn may create, for instance, concerns about the adverse selection when it comes to the listing function. So the third main function that typically regulated markets perform. So whenever you have a change in one of these, you will have an influence on the other. And that's something that is very difficult to predict. That's why regulating trading venues is particularly problematic, because you always have a lot of feedback loops, meaning you change something with a technological development or with a new rule. That's the same in the broad understanding of technology I gave you before. And you will always end up having something that you didn't really expect at the very beginning, because the system on which you are in which you are introducing your new technology or your new rule will adjust to that. So the final result will not exactly the one you are expecting, because every user group will adjust to this kind of variation that you introduce, and every change on every segment of the platform will reverberate on the other segment. So this makes everything particularly complex. And again, this is an approach that you can use when you're addressing more traditional issues. So for instance, what happens if you remove the barriers to the competition? That's something we're seeing with the repeal of the concentration rule already with the MiFID I, but still going on with the technological developments on the matching engines, for instance. It also applies, for instance, to the short-term concerns to some extent. So when the user's preferences are changing, they can affect also the other sides of the market platform. And it applies also, in my opinion, to high-frequency trading, which is exactly the focus of the second part of my presentation, where I now move. So let's apply a little bit this methodology to the high-frequency trading. For those of you who are not perhaps very familiar with high-frequency trading, we're talking about a form of algorithmic trading that is a trading strategy that is relying on computers for the definition of essential elements of the market order. So whether an order should be sent, when, for how many shares, for instance, and for what price. You are talking about high-frequency trading when algorithmic trading develops with a complete reliance on computers, so with no human interventions at all. And you are also relying on a high-speed capacity of the calculation and on low latency, meaning the time span between the moment you send your order and the moment that order reaches the marketplace should be the shortest possible one, meaning getting there first is crucial. When you have these three elements together, then you can talk about high-frequency trading. Now, this is a development that is really challenging, still challenging. It's far from new. But the debate, especially in the academia, a little bit also in the practice, is still quite heated when it comes to, okay, what should we do? To a large extent, we realize that some of the rules we have are not really up to date. But when it comes to fixing them, that's a very difficult story, because you don't know exactly what to expect from the changes you can conceive. So why is high-frequency trading problematic? Well, somebody says that it's basically reducing the interest or the revenues, actually, that you can make out of fundamental analysis. So the traditional investors, such as institutional investors that are gathering the information on the fundamental value of the listed companies, and they are determining their own trading strategy based on those information, can be more difficult, according to some studies. Meaning high-frequency traders can actually appropriate part of the benefits of doing this job. That's a problem. If it's true, that's a big problem, because actually it's mostly fundamental value investors that are making prices significant, meaning being able to reflect the underlying value of a financial instrument, of course, as filtered by the preferences and the expectations by the market participants. But if you don't have these people doing their job because they are regularly outbid by the high frequency traders, then the quality of the market data will be reduced. And also, can this lead to a problem of adverse selection on the primary markets, on the listing segment, on the listing phase of the regulated markets? Because if prices are not able to reflect anymore the quality of the listed companies, then you can have a situation where the long-termism becomes more difficult and more expensive, and you might have a dominant short-termism approach, which is, again, a matter of concern from the point of view of adverse selection on the primary market. Now, these are a little bit the questions that you have from the technological development. They are mirrored, perfectly mirrored by the regulatory challenges. So those questions are reflected into questions that are more directly affecting or addressing the rules that we have in place. So for instance, high-frequency traders typically ground their decisions, whether to send an order or to cancel it, on information which they retrieve from the data feed of the trading venues. And they do that very quickly, so they have their own proprietary mechanism to do that. And the information they rely upon is, of course, already sold by the trading venues, but it's not necessarily yet available to all the market participants. So here, the regulatory question is, when is information concerning trading data, so whether the pre or the post-trade information, when is it public in a legal sense? Perhaps you know that in the market abuse regulation, you perpetrate insider dealing if you trade upon non-public information. Problem is that there is no definition there whatsoever of what public information is. So the question is that that information already public or not? Then we have the vexed question or the so-called back running. According to some scholars, high-frequency traders are able to some extent to predict the next steps of other market participants, and in particular fundamental value traders such as institutional investors, and to take advantage of that. Now, whether that's the case or not is a little bit debated. For sure, they are quick enough, let's say, to take some advantage out of that. But the question is, again, if they're doing that, they do that on the basis of their predictive ability that is not necessarily applied to private information. So that's not insider dealing for sure. But should we still be fine with that, or we are reproducing problems, again, in this case of adverse selection on the secondary market, that are at the very core reason why we are prohibiting insider dealing in the first place? That's another open question. And when it comes to market manipulation, well, we have definitions of market manipulation that basically refer to the fact that you are perpetrating conduct that are conduct that is misleading or deceptive. But the question is, okay, how do we assess whether a high-frequency trading technique is deceptive? Do we test it against human beings or against other algorithmic traders that are working on the market? You can have different answers, but there is no clear standard on that. And also, how about the mens rea requirement? I mean, how do you define whether an algorithm is actually trading a scienter or not? And what if the algorithm through machine learning techniques starts to develop a black box dynamic and delivers outcomes that were not predictable when the algorithm was created in the first place? These are all open regulatory questions. And I think some of them could be addressed by way of regulation, but not all of them. So among those that perhaps could be addressed by way of regulation are perhaps a better definition of the administrative liability. So we should reconsider a little bit whether we should stick to the same negligence standard, or we should move to a strict liability standard as we do in other cases where artificial intelligence is involved, or we might consider, for instance, some other legal basis for the prosecution of manipulation through high-frequency trading, for instance, a negligence, but with some reversal of the burden of proof, which you can do to some extent without violating human rights. Perhaps, and should there be any contributory negligence, for instance, from the side of the trading venues? So if there is a big market manipulation going on, should the trading venues be considered liable if they don't switch off the system, or they do not have filters to prevent this mechanism? We have, of course, a duty for both the owners of the algorithm and so for the investment firms and the trading venues to have filters in place, but it's not entirely clear how you allocate the liability when one or the other or both make things wrong.
Matteo, if you can reach the conclusion.
Yeah, sure. I see I have only 2 other minutes. Okay. What we cannot solve, perhaps, is from a regulatory point of view, is to draw a clear dividing line concerning when we have precisely an algorithm that we can consider as deceptive. And also, it's very difficult to understand whether some practices are detrimental for the other market participants or not. So the question again depends on the user group. And I'm not even trying to run an analysis here, but you have different effects of high frequency trading on different market participants. We have seen already the fundamental value traders, but the announcement traders are also affected typically very negatively. Insider traders are also affected negatively. Market makers normally are using themselves high-frequency trading techniques, so they are better off. Liquidity traders are also better off if there is a lot of high-frequency trading going on out there. Noise traders are a little bit of in between. So again, running an analysis is very complex because it can change depending on the specific user. So defining a perfect rule in that sense, so for instance, defining what should be allowed and not, is, in my opinion, extremely difficult, perhaps impossible. One way to explore, one route to explore, is to see whether trading venues can do that better, because they can perhaps calibrate tools that are not necessarily leading to a qualification of some conducts as illegal or legal, but they can actually more easily create a trading environment that is more or less friendly to high frequency trading. So they can decide whether their system should be more or less welcoming to these new systems. And if there are investors that are uncomfortable with that, they might reflect this into, for instance, a more stringent set of tools that makes high frequency trading less profitable, and vice versa. And perhaps we can have a system that develops different equilibria. So what are these tools? Very quickly, and then I move to the conclusion. So the market microstructure first. You can define your rules for the matching of the orders in a way that are less friendly to high frequency trading, for instance, by introducing frequent batch auctions that fragment the continuous auction. You can go for order types that are more protective for non-high frequency traders, and you can make actually the cancellation of the orders more difficult or more expensive. In this way, perhaps we can reach a system where there is again a different array of trading venues on the market, offering different environments, different trading environments when it comes to their friendliness to high frequency trading. So in the situation where a regulator cannot define a one size fits all approach, perhaps leaving some variance on the market can be the good way. Unfortunately, and here is my last slide, when I said at the very beginning that I have more questions than answers, then of course, if we go along this path, which I think is definitely worth considering, we should then solve some issues concerning the incentives that trading venues have. In the United States, some trading venues turned out to introduce new orders that were actually concealed from the overall public of the market participants, and they were actually meant to help high-frequency traders rather than to make their life more difficult. So, and the reason is clear because, of course, the revenues are coming from there. And also, when it comes to market data, we have a situation now in Europe where now we are trying to reshape it. But the idea will remain that market data will be subject to a form of price regulation, but that's not able to reflect the quality of the market prices. And again, the revenues from the listing are increasingly are decreasing overall throughout the all regulated markets. So do we really have right incentives for trading venues to take that into account? Now, that's a regulatory problem that we will have to cope with sooner or later. So again, more questions than answers, but the main takeaway is perhaps, again, how I believe one should approach these kind of issues. Thanks a lot.
Okay, thank you, Matteo, for your presentation. And we now leave the floor to Federico. But before we do so, I just want to break the atmosphere by showing to especially the one of you who are younger, just 1 minute of what the old stock exchange looked like. Not high frequency trading, not rowboats, but the real stock exchange that we had. It's just 1 minute, and here it is. Okay, so this was shot at the Rome Stock Exchange live, 1967, and this is what we had before. That scene was shot at the Rome Stock Exchange in 1967 by Michelangelo Antonioni, and we've gone a long way since then with algorithms and humming in the silence, but processing millions of transactions in nanoseconds. And Matteo gave us an overview of the regulatory and supervisory implications of this extraordinary technological transformation. So now we leave the floor to Federico Urbani with the DORA draft regulation. Federico, you can start.
Thank you, Professor. Just 1 second for sharing my presentation. And I guess you should see that now. So as you see from the title of the presentation, first of all, we're dealing with a proposal. So we have to be a bit cautious because it's still being discussed. It's now in the hands, the DORA proposal as proposed by the Commission year end of 2020. It's now in the hands of the Council and the European Parliament. So we have to be a bit cautious in dealing with the proposal, but recent developments are meaningful in seeing that no major changes are foreseeable in the drafting of the final text to be approved by the co-legislatures at the European Union level. So with that very brief caveat, as Professor Annunziata mentioned before, first of all, we have to note that the DORA proposal deals with, of course, digital operational resilience, but it is not a standalone proposal. It is not a standalone proposal for a regulation at the European Union level. It is part of the digital finance package presented by the Commission in late September 2020. And that is, of course, to be borne in mind because when we deal with the DORA proposal, we have to keep in our minds that it is part of a broader package, and it makes sense from a policy standpoint when looked upon having in mind also the other pillars of the digital finance package. Of course, the digital finance strategy, which is a bit broader, and it is a policy document more rather than a piece of hard law legislation. But of course, it has to be seen along with the MICAR proposal that was mentioned before and the DLT infrastructure one. So it is one of the, I would say, 3 pillars composing the digital finance package. And as mentioned by Professor Annunziata before, it is maybe the least flashy. So when the press release of the Commission came out late September 2020, your attention would be naturally drawn to the MICAR proposal, and maybe as a second step to the DLT infrastructure proposal, both in terms of how they look like more interesting for any person operating in the market. So also as an investor, as a consumer of those assets, or a person accessing that infrastructure, so the DLT one. So your attention would be naturally drawn first to those pieces of proposed legislation. Then you find the DORA proposal, which is indeed less flashy. So it is a bit more of the dark side of the moon of the digital finance package, because you don't really, you're not really interested in going deeper into that, but it is indeed half, I would say, of the pieces of legislation under the umbrella of the digital finance package. Why is it the dark side? Maybe because, and this is purely behavioral, I would say, because it is less of an immediate piece of legislation for those accessing the market from the investor and client side. So the side of the market access, which I guess any of us would be more comfortable in imagining us. But if you look at it from not the consumer side, not the investor side, rather the institutional side, and also the supervisor side, there is always a side of the legislation in the banking and in insurance and financial sector, which is not seen, but is indeed important. So, as you may see, the digital finance package, which we all know, has some primary goals. First and foremost, making Europe fit for the digital age. That is needed because the world is changing, and the policy approach as well as the legislation need to be up to pace with the changes occurring around us. Then the package, of course, one of its purposes is enabling and supporting the potential of digital finance. And again, this is a purpose really practical in a sense. What I mean by that is that it tries to run along what market practices are and how practices are changing and new assets are developed and new investments may be done and new infrastructures are set up. So this is really a run-up piece of legislation and general policy purpose. Then the first point that you see is that of mitigating risks arising out of the digital transition of finance. And really the third pillar of the digital finance package, which is DORA, is really focused on risk mitigation, organization of intermediaries and companies operating in supervised and highly regulated European markets, of course, also in terms of organizational structures, governance, and supervision. That is needed because digital operational resilience comes along with the digitalization of finance practices and market structures and so on. So really it is something which is needed because of a change in how transactions are now carried out and new products are placed on the market. DORA is necessary because the set of rules that were adopted in the wake of the financial crisis almost 15 years ago were focused on financial resilience. So as you see mentioned in the slide, increasing or incrementing capital resources and liquidity of financial entities, as well, of course, with tools of reduction of market and credit risks, but it did not deal as a primary piece of legislation with digital resilience and digital operational resilience. So this means that the DORA proposal is really a supplementing measure to already existing pieces of legislation under the European level of legislation umbrella. And it comes along with the increasing digitalization of market services and products of assets. And when we see products and assets, we talk, of course, about the MICAR proposal. And when we talk about markets and infrastructure, we talk about the DLT infrastructure proposal. So you see that putting together the three pillars of the digital finance package, and if you look at them as a whole, so not individually, not autonomously, you may find before yourself a comprehensive set of rules to make the European framework of banking, insurance, and financial law and operations fit for the digital age. Of course, the fact that the DORA is a proposal for a regulation evidences us and shows us that what the policymaker at the European Union level is seeking is not, of course, the adoption of soft law measures, but not even of, I would say, basic harmonization rules under a directive. What it's seeking through the DORA, which is a proposal for a regulation, of course, is to have a fully integrated set of rules, so a level playing field across the European Union and the internal market. So this is a further step in creating a single rule book of hard instruments, so hard pieces of legislation, so not only soft law, applicable across the Union and within the internal market as a whole. Of course, the purpose of DORA is multifaceted. So DORA is not an act, a proposal for an act dealing with only one area of legislation or rules. It deals with a number of policy objectives and legislation objectives, and in doing so, it has a multifaceted set of purposes. So on the one hand, you will find a number of rules, hard law rules again, which deal with ICT, risk management, testing systems, incidents, and so on. So that is really the technical part of DORA, and it might be difficult to understand for scholars dealing with other pieces of legislation in general. That is, again, hard law, and it is profoundly technical. So this is the first macro area of proposals within the DORA Act. A second, and maybe more interesting in a way, set of rules under the DORA is that of third-party dependencies and the regulation of third parties' relationship by financial institution with entities which are outside not only their group, of course, but also outside of the perimeter of entities which fall under the umbrella of current supervision of banking, insurance, and financial sectors at the European Union level. So what the proposal seeks is to draw under the umbrella of the current supervisory tools of third parties, critical ones. I will go a bit deeper into that in a couple of minutes, So what it seeks to do, DORA, is drawing under the umbrella of the current supervisory regime of entities which have never been supervised before, so expanding the number of entities and the type of activities which are overseen by European authorities. As we said, the full harmonization of this area is, I mean, one of the pillars of DORA itself, as what we're looking at is not a soft harmonization set of measures, rather a full harmonization proposal. When we talked about third-party dependencies and third parties' relationship of financial institutions with entities providing services to them, and again, those entities currently and historically fall outside of the perimeter of supervision. We're talking about something which is absolutely widespread in the market and is essential for financial institutions. So, as you may see from the slide, this is just an example, as the ECB had the chance to show us, is that third-party relationship or outsourcing relationship and third-party dependencies of financial institutions from third-party services and activities, it's not something that happens rarely on the market. Rather, it happens very often, and the more the service of activity to be provided or to be developed is characterized by a technological component. So the more you go along the technology side of services and activities, the more you will find in financial institutions the dealing with third parties. Therefore, the dependency of financial institutions, who are of course highly regulated and supervised, on services and activities rendered and performed for their benefit by third parties who do not currently fall under the umbrella of regulation and supervision. So the perimeter of regulation and supervision is expanding in order to capture those entities who are currently part, from a substantial point of view, of the performance of banking, insurance, and financial activities. So they have an impact on banking, insurance, and financial products, activities, and relationship with clients, and so on, and investors, but they fall nonetheless outside the perimeter of the supervision. So if you look at the chart, you will see that the use of outsourcing by institutions regulated and supervised is not the exception, it is absolutely the rule. And the more technology comes into play, the more you will see third-party dependencies. Of course, third-party dependencies may be of great benefit for the financial institution itself and for the third parties entering into relationship, for example, as clients with that institution. Nonetheless, it bears with it a number of risk profiles. I have tried just to isolate a number of them in the slide. You will see there's plenty of risks arising out of third-party relationships and dependencies. They are not all, and you may see that they are absolutely relevant for financial institutions and for the resilience of the market as a whole, of the system, and of institutions on a standalone basis. Also, here are some data from recent data from the Italian market. You will see that when developing financially highly technological products and carrying out technological activities, institutions rely greatly upon third-party contributions and activities. When we said that there are risks arising out of dependencies and relationship with third parties within the DORA framework, we could ask ourselves whether these are just theoretical doubts, these are abstract risks, and whether institutions do intercept them as something which is actually already existing. And here you find some truly daunting evidence from the market. You will see that what the DORA will ask financial institutions to implement in terms of safeguards, limitations, and so on in dealing with third parties, so independent from third parties' activities, is not something that the market will, I guess, try to avoid or try to battle, because you see that it's the market itself, so it's the financial institutions themselves who admit that there are critical issues now in the market, and those issues need to be dealt with, and that's the main purpose of DORA. Why is then DORA a game changer? So DORA is first of all a game changer in terms of how the legislation is structured and how the legislation will look like in a few months. So as I said, DORA is not to be seen and should not be seen, and I guess will not be seen as a standalone piece of legislation. Rather, it is fully integrated within the single rule book, which is of course not closed as a project and will never be eventually. So it should be seen as part of the rule book, and part of the rule book as a hard law act, so as a hard law piece of legislation. So this is quite fundamental because, as you may see, this is a turning point in terms of how the legislation is being developed and how the integration of national legislations has now led to, at least in certain areas, not only to harmonization to a certain extent, rather to full harmonization. And of course, DORA itself, even though it's a broad act, it's a long act, detailed and technical, I would see it as part, so as a specification of Article 74 of CRD. So when Article 74 talks about robust governance, clear organizational structure, adequate internal control mechanism, sound administration, sound and effective risk management, it deals with general management, governance, organizational goals from a cross-sectoral point of view. DORA will implement those policy objectives with a hard law piece of legislation looking mainly at digital operational resilience, thus supplementing, implementing, and giving full effect to that extent to Article 74 of CRD. Again, the turning point of the current legislation in this sector is that DORA, as said, is not soft law anymore. We have been used to seeing in the areas now touched upon by DORA of a number of soft law measures and not harmonized, maybe even hard law, but national measures. DORA will wipe that out, so we will have a hard law harmonization tool, full harmonization tool. Also, DORA is truly cross-sectoral from a financial institution standpoint. So DORA does not deal only with credit institutions, so with banks, insurance companies alone. It deals with and it addresses the vast number of financial entities. I would say almost all of the relevant financial entities now regulated under the European Union umbrella. So it is truly cross-sectoral, and there the term act in the name of the DORA comes full into force in our minds. from a broader point of view, of course, Article 74 of the CRD is quite a broad piece of legislation in the banking sector. But what DORA pushes institutions to do is to focus not only on specific countermeasures and safeguards and so on, it pushes institutions, again, a vast number of institutions, to focus on, in broader terms, on their business model as a whole, so to have a better defined strategy in terms of ICT and technology within the financial institution, not at a micro level, rather at a macro level of the business model itself and the risk management. Last item evidencing why DORA is truly a game changer, is soon to become a game changer in the panorama of the European legal framework, is that, as mentioned, what DORA will mean for financial institutions is that they will no longer be agents of the supervisor, so of national and supranational authorities when supervising the banking, insurance, and financial sectors. So financial institutions will be relieved in a way, because they will not act anymore as agents of the supervisors when dealing with third parties and when depending on third party services and activities. Why that? Because, as said, DORA attracts within the perimeter of regulation, and most importantly of public supervision, entities which currently and historically still fall outside the perimeter of supervision. So current soft law measures required financial institutions to act as agents of the supervisors in dealing with third parties in order to mitigate potential risks for the system, for the market, for clients and investors. Now, with the DORA proposal, there would be direct oversight of critical ICT third-party service provider. So institutions will be relieved of their acting as agents of supervisor in dealing with third parties. So I think that I can end here my presentation, and I'll give back the floor to Professor Annunziata and Federico. Thank you.
Thank you. Thank you, Federico, for your presentation of this very important regulation. As you were saying, it has the capacity also of changing the way with which we look at traditional rules on outsourcing, and even impact on supervision as well. So I guess that now we can leave the floor to Q&As, questions coming from participants, since we have a little bit of more flexibility due to the unexpected absence of Andrea Minto. I think that all these presentations really raise a number of interesting questions, and most importantly, they seem really not to reach any conclusion, or at least just in part, but to set on the table topics for further discussion. So I also imagine that all of you will go on in their research in these areas, because the debate is basically open, and technology is ever changing, and once you solve one problem, then technology evolves and you have another problem on the table, so it's a never-ending chase. So if anybody wants to comment or to ask something, we are very happy to open up a discussion.
Okay, well, actually, I have to say that I really enjoyed the other two presentations. So I took note of one. Well, I don't even know if there are comments or questions for each of them. So I don't know. Perhaps I can follow the order. I have one again comment slash question for Maria Lucia. Well, thank you very much. I have to say, I find your analysis very compelling, also the empirical part. Excellent. I was reading a couple of weeks ago an article by Bobby Reddy on the Journal of Corporate Law Studies, and basically he said something like, well, SPACs are good investments, but not that good for retail investors, especially if they have a long-term perspective, meaning that typically what you where you can lose money is that if you buy on the secondary market, because perhaps the retail access to the primary market is not that easy, and then if you hold for too long, then you might really lose money. I don't know whether your analysis, which is very detailed, I have to say, is in line with this understanding, or if you reach any different conclusions.
Yeah, it's perfectly matching this, especially, or I should say, although only related to the US market. Definitely there we had the largest number of transactions. So it perfectly matches that. And to some extent, it also really entails a couple of differences that we saw in terms of the relevance of the attitude of several investors. So the bank's attitude towards SPACs should be kind of different rather than retail's investor one. But generally speaking, what actually matches the most is the short-termist kind of attitudes of investors towards this kind of instrument or additional tool, we should say. That paper is very interesting, and it's very interesting also because together with another companion paper with, if I remember correctly, Brian Keffins actually tries to understand how the UK market, more specifically right now, which is being kind of reshaped after Brexit in terms of financial markets more generally, can take advantage of this kind of experiences abroad and be competitive, I should say, probably again or still as it was before. So that's really relevant. Thank you.
Thank you. Thanks a lot. Well, perhaps I can continue. Well, I have to say this is also reproducing the general issue concerning the retail access to the IPO segment, which is a kind of an issue that really cuts across the board. So you can also see it here, perhaps. Yeah. Sorry, then a quick question / comment, and also on the second presentation, since I see no questions in the chat box. Thank you so much also for your presentation. I really like that, Federico. I have to say I was listening to it with the eye of a former supervisor, and I cannot really say too much, but I remember when we were actually open some call for tender or for public procurements, let's say, for the supervisory. Actually, even supervisors will rely, and already do rely, a lot on third-party providers. And there you always have these concerns, meaning what if I am buying my software from the same persons that are actually producing it for the market participants? So I don't know if you ever had a thought about it, or if you have any ideas. Yeah. Honestly, I wouldn't know how to solve it easily.
No, I don't know whether there's a way to solve it, because you really would have to compress freedom to purchase, for example, software and so on. So that's an issue. That's an issue with RegTech, for example, because there you have, and this has been noted by the OECD, for example, and the IMF in their RegTech papers, so that the best, so to say, providers to private parties are those, and whether this is a coincidence or not, a mere chance or not, of supervisors, because of course they have great expertise in what, I mean, to see it in a good way, what the supervisor would want to expect and expects. So if you look at it from a pure good faith side, so to say, that's pure expertise building. But yes, you have no compression of that kind of freedom right now. So yeah, from the side of the supervisor, you have, in a way, the same concerns on third-party dependencies and so on. And of course, it is an issue. I mean, it has happened that when certain huge server providers and cloud providers went down, also supervisors went down. So that's maybe more of a public policy perspective, but it's an issue. Of course, it's the same issue, different consequences, no regulation foreseen, but same issue. Yeah, of course.
Well, you clearly see that there is this uncertainty in, when you look at technology, this is valid for algorithms, high frequency trading, digital operational resilience, distributed ledger technology. You know, regulators are still uncertain as to whether they should regulate and supervise directly that part or indirectly through the traditional supervised entities. And they still haven't really decided what to do, because I mean, at a certain point, they might even say we have to take direct control. So, I mean, if you are an entity that produces algorithms that are used for high frequency trading, you need a license. You're supervised as an algorithm producer. But that's not really what that's not really what's happening. So we have this sort of gray area where you indirectly regulate and supervise, but you leave technology outside the scope of direct supervision. And when it comes to decentralized finance, the question is whether this approach really makes sense in the end or not, because decentralized finance is all about technology, but you don't even have the traditional entry point of a supervised entity to control that technology. So, but we are, I mean, it's very interesting. It's an old dilemma, eh, Matteo?
I have to confess that some of the participants also tend to show off or to advertise their own product, like say, well, we are the same ones doing that for the market participants, so we are the best ones on the market, which is true, but of course it raises a sort of a conflict of interest problem.
Yeah, but ultimately then the question is, should financial regulation and supervision really supervise technology directly or the financial industry? I mean, well, okay. So, Federico number one, Federico Riganti. I think that
Yes, we can stop here.
you can stop, yes.
Yeah, so I wish to thank you once again for this day. And once again, we were going to meet again on the 5th of May for our next meeting concerning sustainability. So all the information will be published soon. Are they already published on the website? And once again, will be published and sent to the emails and so on to everyone with all the information possible. And that's it. So thank you to you as well, Professor Annunziata. So wish you a very nice, hopefully long weekend, but not sure about that.
And happy Easter.
Of course, happy Easter. Yeah.
Bye. Cheers.
Bye.
Thank you very much.
Bye.
Bye, everybody.
Bye.
Thank you.